Welcome everyone to the third last in our series, CAFIN series on financial risks, innovation, and inclusion. Today's topic is on the U.S. Treasury market, and interestingly enough, this was featured in The Economist magazine just this week. And another point of note is that this year's Nobel Prize for economics went to two experts, Paul Milgram and Bob Wilson, in the field of auctions. I'd like to welcome all of you, and in particular my co-director Galina Hale and the Chief Investment Officer of the University of California, Jagdeep Bachcher. They are co-sponsors with CAFIN of the series. I'll just briefly introduce our moderator, Peter Crampton. Peter is associated with the University of Cologne. He is an expert in market design, and interestingly enough, he worked with Bob Wilson at Stanford when he got his PhD. Peter and Darrell both, I think, are quite remarkable in terms of doing cutting-edge theoretical work and also finding very important practical applications for that cutting-edge theory. I won't say more. You should definitely look at what Peter has done online. And I'll just hand over to Peter now to introduce Darrell and the talk. Thank you.
Good, thank you very much. Well, I'm sure you all know Darrell Duffy, so I'm not going to say too much about Darrell, but I will say something that you probably don't know, and that is that Darrell Duffy and I met happily 40 years ago at Stanford as first-year PhD students, taking a class in the fall on real analysis. And one of the first things I learned was Darrell is the smartest guy in the room. Well, maybe the professor, but he was clearly a standout then in that fall semester of 1980. And I've had the joy of seeing his career progress over the last 40 years, just writing brilliant paper after brilliant paper in the field of finance. And, it's definitely continuing to this day. If anything, he's accelerating his contributions, probably because of the depth of his experience learned over those 40 years. So, for example, this is one little example, the size discovery paper that he wrote recently is one that everybody should look at. And anyway, one of the things I admire and try to do myself in my own work is, basically call out when we're doing something in our economy that doesn't make any sense, to call it out and suggest how it could be improved. And I'm hoping that we're going to have that sort of discussion to the extent that the auctioning of treasuries is not perfect at this moment. Perhaps there's some ways that we could improve the way it's done in order to better achieve the goals of servicing the debt at least cost. So with that, Darrell, let me pass the baton to you.
Thank you so much, Peter, for that those very generous remarks. I'm actually going to call you out on your contributions to market design. I've been following your work since we were both students, and I view you as one of the world's top experts, top handful, very few experts in financial market design and market design in a much broader context. And I'm familiar with your work on the practical side and spectrum auctions and diamond markets and many other markets that have benefited from your work. And Nirvikar was inspired to ask you to be speaking with me and everyone today on this issue, because it is fundamentally a market design problem. As Nirvikar said, the problem is related to US Treasury markets. It is a design problem. The markets for US Treasury securities became dysfunctional on the COVID crisis in March of this year. And I was asked by the Brookings Institution to look into why it became dysfunctional. And I discovered it was a market structure problem. And I want to tell everyone about that and get Peter's reaction to it. So I'm going to share slides with everyone. And I'm going to walk through this for about 25 to 30 minutes. And then I'm going to hope that everybody listening is going to send questions into the Q&A function that Peter can react to or ask me to react to in the last portion of our discussion today. And I do want to thank Galina and Jagdeep and Nirbakar and the whole team at UC Santa Cruz for hosting and sponsoring this event. So let me briefly explain what happened in March and then how it can be diagnosed as a market design problem. So in March of this year, as everybody knows, massive news about the COVID pandemic hammered financial markets generally and triggered in bond markets what's called a dash for cash, meaning investors in bonds needed cash in a hurry to meet all of their other obligations and to get out of harm's way in their financial positions, and they sold massive amounts of treasuries. Now, the way that the US Treasury market is designed currently is that all investor trades are not traded on an exchange, but rather they are handled by dealers. So this is a dealer intermediated market, and almost all of that is bank affiliated dealers. So these are firms, the household names like JP Morgan, Goldman Sachs, Morgan Stanley, Citibank, Bank of America. Those 5 firms are the largest in the US, and they are also the largest in the world in terms of intermediation of US Treasury markets. Now, the regulators in the US learned something from the last financial crisis of 2008 and 9, which is that those banks were not sufficiently well capitalized. They were fragile. And so regulators forced those banks to have much stronger capital through regulation. And that regulation limited the amount of treasury sales that those dealers could absorb onto their balance sheets. They were simply not authorized to buy more than a given amount of treasuries before they resold them, unless they raised new equity, and that's just not possible on short notice. So what happened is that the whole bond market choked, and particularly the US Treasury market choked on those huge investor trade demands. The problem again being all the trades had to be handled by a small subset of bank affiliated dealers who just weren't equipped to handle the flows. Very simple. So what did central banks do? They responded well with massive bond purchases. They basically took those treasuries and in foreign markets, other government securities out of the hands of dealers as fast as they could in order to free up space on those the dealer balance sheets so the dealers could handle more investor flows. And the Fed this year alone will have purchased $3.2 trillion of government securities by the end of the year. That's 15% of US GDP. And that is not part of the emergency Main Street lending programs or all of the other programs of the Fed. That's just buying of government securities, both treasuries and agency securities. And similarly, the European Central Bank and the Bank of England bought enormous amounts of government securities in order to free up space on dealer balance sheets. Now, those kinds of rescues are appropriate. The central bank, that's its job, to provide liquidity when the market is frozen like it was in March. It doesn't happen very often. It happened in the last century only a few times. For example, on the opening of the Second World War, the Fed had to step in because of massive sales of US Treasury securities and rescue the Treasury market. This is not a typical kind of quantitative easing program. Here are the sales in early March of this year on weekly basis. So in 1 week, on the first week of this crisis, the Fed bought over $250 billion of treasuries. On the second week, over $350 billion. And in the first 3 weeks alone, over $1 trillion of US Treasury securities were purchased by the Fed almost entirely in order to get them out of the way of the dealers so that the dealers could handle more flows. Here is the problem with the way that Treasury securities are intermediated in US and in fact in many financial markets. And if you'll pardon the schematic, the idea is that the blue dots are the investors who want to trade these securities. The green dots are the dealers that intermediate these flows. And you'll notice that all of the blue dots sell directly to dealers. They do not sell to each other. So investors can't sell to investors. They can only sell to dealers, whether bilaterally or through a multilateral trade platform. The dealers, on the other hand, have within their own circle all-to-all trade on a central limit order book, to which the investors do not have access. Again, the problem that became apparent in March is that since every trade must go onto a dealer's balance sheet, once those balance sheets are stuffed to the maximum allowed by regulation, the flows have to slow down until the dealers can get them back off again. And that's why the Fed stepped in and purchased so many in a short time. And by the end of my remarks, you'll see that I don't think this market design is appropriate. We should be building the market design so that the blue dots can directly access each other, and not all of the flows have to be intermediated across dealer balance sheets. Let me explain why this is a growing problem in the United States. And this slide will take probably more time than any of them because I want to go through it with care. This is my diagnosis of the problem. The red bars in this diagram in trillions of dollars show from 1998 to now the total balance sheet size of the largest US dealers. And you can see, if you can follow my cursor, in the years leading up to the financial crisis, the amount of space on dealer balance sheets tripled to over $10 trillion. Then the financial crisis hit and regulators got serious about regulating those balance sheets. And because of capital regulations and other regulations, the growth rate of those balance sheets tailed off quite dramatically. So instead of a tripling, those balance sheets are roughly back, 12 years later, back where they were on the opening of the crisis. The blue bars in this diagram are the total amount of US Treasury securities outstanding. And you can see that before the financial crisis of 2008, the blue bars were growing slower than the red bars. But after the financial crisis, because of enormous US deficits, the blue bars began to grow dramatically faster than the red bars and are projected to grow even much faster because of COVID pandemic expenditures, which are enormous, over $3 trillion this year alone. So if you believe, as I do right now, that in 2020, the balance sheets of the dealers are not big enough to handle surge demands for liquidity, given by the size of these blue bars, or proportionate to the size of these blue bars, then you can easily imagine that this problem that we experienced in March of this year is going to get much worse as these blue bars get bigger and bigger. Let me scare you a little bit more about that problem. This is the same diagram extended to the year 2050 using Congressional Budget Office projections for the growth of the supply of US Treasury securities, which are going to go from about 20 trillion this year to 120 trillion, a staggering amount of treasuries. Meanwhile, I'm projecting dealer balance sheets to grow as they have been with US GDP growth rates. And you can see that in a decade or so, a much smaller pandemic or other macro shock will be more than sufficient to overwhelm those dealer balance sheets. And we'll be back where we were in March, where the Fed had to rescue the market. And you might say, well, couldn't the Fed just rescue the market every time it gets into trouble? That's what economists call moral hazard. It means that financial market participants will be relying on the Fed to get them out of trouble and will not properly risk manage their positions. And moreover, the market design that's better able to intermediate the market will be stifled by the prospect of getting rescued every time there's a problem. So we really need to stop relying on the Fed to rescue the market, even though in the instance it needs to. This is an indication of the flows that occurred in March relative to normal. So on the horizontal axis of this diagram is the foreign gross sales of US Treasury securities to US residents, almost all of whom are US dealers. And so you can see typically in a given month, this histogram shows a median of around 1.2 trillion-ish of foreign sales to US residents. I marked in this red dot March of this year, the COVID month of pandemic dash for cash. And you can see it's more than double the norm, and it's a standout outlier among all months. So 2.7 trillion, and that's just foreign residents alone. My estimates are that roughly 5 trillion in total of Treasury securities from investors to dealers had to be handled by the dealers in March of this year, a staggering amount. So what happened? Well, if you're a dealer and you're getting a flood of requests for trades that you can't handle, what would you do? You would simply increase your bid offer spread so as to ration the space that you have on your balance sheet and make as much money as you can. And that's completely appropriate. That's not immoral. That's what market participants do. They widen their bid offer spread when they can't handle more inventory. This chart shows bid offer spreads from investors to dealers. That is the quoted bid offer spread that investors offer dealers, normalized to 100 at the beginning of the year. This chart was prepared and first shown by Lori Logan, the manager of the System Open Market Account and head of Open Market Trading Desk at the Federal Reserve Bank of New York. So this is the official who's most responsible for rescuing the market in March. And she showed that bid offer spreads went up by a factor of more than 12 at the worst. So this is a dramatic illustration of the loss of liquidity to US investors, where they had to pay 12 times normal to get their securities handled by dealers. These are similar effects in the interdealer market for US Treasuries in black, and in other places in the world. In the United Kingdom, the gilts, that's the UK government securities, had an even bigger problem. And in Germany, the Bund, that's the German government securities, they had a big problem as well. So this is not specific to the United States. In the interdealer market, the amount of securities available for trade shrunk enormously. So this is called market depth. Let me explain this, this slide carefully because it might otherwise be confusing. So by day during the COVID period, what we're seeing on the vertical axis, let's say in the black series, which is New York, the amount of Treasury securities that dealers were willing to buy, as indicated by the orders on the limit order book, the first 3 best prices. So if you wanted to sell Treasuries and you were willing to take the best 3 available prices on the limit order book, you would be able to liquidate about 175 million just before the COVID crisis. That's a lot of market depth. The US Treasury securities market is normally the deepest market in the world. Once the pandemic news hit and dealer balance sheet space disappeared, the amount that they offered for to absorb on short notice in terms of the limit order book shrunk down to perhaps 10 million. That's, a small fraction of what had been available in terms of liquidity. And similar effects were apparent in both London and Tokyo. These are the volumes of sales in the Treasury market. I'm not going to go into this in detail, but you can see this was not a problem where the dealers simply shut down their operations and said, no, we're not going to handle any trades more than normal. They actually expanded the amount of liquidity that they offered by a factor of 2 in the COVID period. So there was an enormous demand for trade that the dealers met double normal, but at a point, they couldn't handle any more. There was just too much demand for trade, and they increased their bid offer spreads and reduced their market depth very, very significantly, and the market froze up. It was notably bad and volatile pricing, where the prices of very similar Treasury securities began to diverge simply because of a lack of liquidity in the market. It was widely noted and reported on the front pages of almost all of the important financial and mainstream news press. Now I want to talk about, let me change gears entirely for the last few minutes. And I'm very interested to get Peter's reaction to my next comments. I want to talk about what might be done in order to mitigate this problem going forward, other than having the Fed rescue the market every time that it happens. So what might be done, as I mentioned earlier, is to make the market design, to have that market design allow the possibility of one investor immediately trading with another investor. And that you could call that exchange-based trade. That's all-to-all trade. We don't have that now in the Treasury market. How could that be done? Well, a necessary condition is called central clearing. This is a piece of financial market infrastructure that basically says whenever Peter wants to sell a Treasury, I don't need to rely on him if I'm the buyer. I'm simply going to rely on the central counterparty to process the trade and make sure that I get paid for my securities. And likewise, Peter is going to rely on a central counterparty to make sure that he gets paid. So we can basically trade anonymously and not worry about bilateral settlement. So this is called, this financial market infrastructure is called a central counterparty, or CCP. And it sits in the middle of the market. And it actually exists right now for the dealers themselves. So if you're a dealer in this market, say Peter and I are dealers 1 and 2, and we make a trade, we don't need to rely on bilateral settlement. We novate our trade to the central counterparty, which is then responsible for ensuring the settlement to each of us. And it's backed up by capital and liquidity commitments of the entire dealer community. You can see in this diagram that the investor customers of the dealers are not hooked up to the central counterparty. And so when they make their trades, they're all bilaterally settled with the dealers. And what that means is one customer cannot trade directly with another because they can't clear their trades through the central counterparty. Currently in the US Treasury market, a firm facing a counterparty is facing the CCP on only about 22% of US Treasury securities transactions. So 78% are not centrally cleared. My proposal is that the US government, the official sector, do a serious quantitative study of mandating central clearing for all large investors in US Treasury securities. What that would do is allow direct all-to-all trade, because now customers 1 and 2 don't need to trade directly with a dealer. They could trade with each other because they would be able to clear their trades at the central counterparty. And by doing that, a lot of space on dealer balance sheets would be freed up. An additional benefit is, of course, safety, the safety aspect of settlement, because right now we have a lot of settlement risk that's not being guaranteed by a central counterparty. An additional benefit of that is the netting of trades on dealer balance sheets. Let me go back to the current market design. When Peter and I make a trade with each other, let's suppose Peter buys 100 billion from me, Peter may have sold 80 billion to Nirvikar. So Peter now has 180 billion of commitments to settle US Treasury trades. That's 180 billion that's clogging up his balance sheet for another day. If he were to have centrally cleared those two trades, 100 long, 80 short, he would have a commitment on his balance sheet, once centrally cleared, of only 20 billion, the difference between the two. So that's a factor of 9 savings in the amount of balance sheet space that's taken up. And you might say, well, yeah, it's only for one day. But remember, these flows are in the trillions per month. Roughly 5 trillion a month from investor flows and another 5 trillion in the interdealer market. So just saving the pipeline space of one day's settlement through netting is a significant effect. So 3 benefits: safer settlement, netting benefits of netting long against short so as to use balance sheet space more efficiently, and then allowing direct customer to customer trade so that not all trades have to go ever onto a dealer balance sheet. The three effects, I think, are definitely, I should say, very likely to be worth the cost. But all I've suggested in my proposal, which is in my Brookings Institution working paper on my website, is that the government begin a quantitative study of how to do this. The data are not available to economists like Peter and me because, believe it or not, US Treasury securities transactions are not publicly reported, not even anonymously, as opposed to the equities and exchange market. I want to say one last thing before I turn it over to Peter to moderate the Q&A. One of the initial reactions I got was, well, do you think the Treasury market being so big could actually handle that amount of settlement risk at a central counterparty? So what I did is I went and I plotted the total amount of settlement risk in the US 10-year note, which is it's the heaviest settlement risk security in the US Treasury market. And you can see that one-day settlement risk in the entire US Treasury market in the 10-year is on the order of $1.5 billion. That's a sizable amount. That means that if everything went wrong, market participants could lose up to $1.5 billion from a one-day settlement fail, if every single trade failed. If you go to securities that are already centrally cleared in the US equities market, the biggest one there is the S&P 500 ETF, which is called the SPDR SP 500. And you can see that that security has a one-day settlement risk that's about 3 times as big. So central clearing is already working in the exchange-based equities market and handles very, very significant amounts of risk. It is true, though, that if you were to create this piece of financial market infrastructure, a CCP for treasuries, it would be systemically important. You might as well say it would be too big to fail. And that's another question I often got. Do you really want to create another too big to fail type of financial institution? And the answer in this case is yes, I believe so, because I believe it can be safely regulated. And I believe that in the worst case scenario, the Central Bank of the United States, the Fed, would be willing to accept US Treasury securities from the CCP as collateral to provide liquidity to the CCP when needed, as a last case lender of last resort. Taking US Treasury securities as collateral is not unsafe, and it's well within the remit of the Federal Reserve System. So with that, Peter, I'm going to pass it back to you, and I'd be delighted to get either your reactions or any commentary coming in from people watching.
Thank you so much, Darrell. Boy, that's just a tremendous story. You articulated the complex subject in a very effective and convincing way, and you proposed the remedy, which to my mind is simple and right. And I think that you were very cautious in making the recommendation that we do a serious quantitative study to look at this, which is basically, let's take a baby step, and let's take this baby step quickly because this is really important and a problem that we must address. And I think that that's probably good under the circumstances, but I think that quickly you'll want to turn up the volume on, this is obviously the way to go. And the question is, how can we get from point A to point B in a politically feasible way, which will involve a lot of challenges. But we should meet those challenges. And so I think it's, it's brilliant to just say, where we have to go. And I think that, we should be able to do it. And what I wanted to do is just very quickly give you the example, another example that this stuff works, and it works in domains of the economy that are of critical importance, like finance, and it works flawlessly. And the example is wholesale electricity markets, where we trade with central clearing on a daily basis. The markets actually run on the fastest markets are on a 4-second basis, but it's central clearing, uniform price auctions, maximize social welfare subject to constraints. It's computationally a very challenging problem. It is, and nonetheless, and of course we have issues of parties failing and having sufficient collateral to guarantee performance. We've been doing this for multiple decades. The dollar amounts involved are hundreds of millions of dollars, which might seem small compared to the trillions that you're talking about, but this is over very short periods of time. In a world where there's lots of uncertainty, there's the price volatility that we have in electricity markets is enormous compared to what you have in financial markets. So it's not uncommon from the price of electricity to move from minus $30 per megawatt hour to $9,000 per megawatt hour. And yet we have enormous, we have hurricanes, we have major outages, and this stuff happens all the time. The lights stay on in most states, maybe not all the time in California, but in most states, they actually stay on pretty much all the time. And when they fail, it's usually a market design flaw where they basically haven't let the market work as well as it should by constraining price, which is one of the big problems in California, and getting the demand side is involved. So, we have that. So you can point to that as an example of, yes, this works. This is not a problem. The stakes are not a problem. We also, in electricity, it's an interesting comparison. We have complete transparency of bids. And after 90 days, all bids of all participants are made visible. And so we have a wealth of information with which for researchers to see if there's problems, to address issues of potential market failure, such as market power, and so on. And the market is constantly evolving with minor rule changes to enhance it and improve it more, which is done through a very effective governance structure. So I think that would be a very good example to point to and say, look here, the reason we don't have this in finance is very simple. It's because the dealers like making money. Okay, that's fine, but we shouldn't sacrifice our economy to please the dealers. And also the HFT, they love this volatility. It's great for them. If the bid-ask spreads go up by a factor of 12, that's money in their pocket. So great for them. So they'll lobby for this, for status quo. That's great, but somebody should be arguing the other side. We don't just have to listen to the dealers and the HFT, who quite frankly, they're doing what they should be doing. They should be representing their interest. But we need to have some voice on the other side and, essentially keep the lights on. And that's what you're talking about. And so these rescues, they should be extremely rare, like once every 20 years, not several times a year or, every other year or something like that. They should be extremely rare. So anyway, I guess why don't we start with you just reacting to my example, and then we can turn to all the other questions. There's a ton of questions here that people have raised. And by the way, all the people that have asked questions, I want to say, Darrell will get all these questions and he'll respond to them, but we won't be able to respond to them all by 10 o'clock.
Thanks, Peter. Well, first, and now I need to learn more from you about the central clearing and the electricity market. I wasn't aware that it played such a crucial role. But given the volatility that you've described and the fact that there hasn't been a failure of central clearing in that market, I think that's a testament to the fact that a well-regulated well-designed market can really work. And I mentioned the case of US equity markets. We noticed that in March, despite the enormous volatility in US equity markets, there was nary a thought that the market would become dysfunctional. And in fact, I got a message with a note, a technical note this morning from two researchers at the Bank of Israel, whose government bond markets are exchange traded and centrally cleared. And there was not anywhere close to the problems in that bond market that we had in the US, nor in the United Kingdom and Germany, which are dealer intermediated markets. I want to also react to the point that you made that there are vested interests, there would be winners and losers, but I have seen in some conversations since I first brought this up, some degree of give and take in the dealer community about the benefits of going this way. They're not just stonewalling it. And I think the reason is that they understand that with the growth in the US Treasury market, that they're going to be on the hot seat when this happens again. And they want to get out in front of that problem so that even though they had a profitable franchise and they made a ton of money in March and April this year, all-time bumper record profits in bond trading because of what happened, they don't want to be, I think, sitting in front of or blocking a major improvement in financial market design and being blamed for it. So I do think that the official sector is moving. I see in public speeches and remarks that it's moving. It's in the Fed's financial stability report that just came out this week, and in supporting comments by Governor Lael Brainerd, who is touted as one of the leading candidates to be the next US Treasury Secretary. And I also see it in other official sector and private comments. So I'm relatively optimistic that there'll be movement on this, and I'd love to get to move along now to some of the questions that have been coming in. Actually, I see a lot of them.
Yes. Yeah. So one of them from Galena Hale is that, well, who could provide this central clearing function? And just to give the example from electricity, the central clearing function is provided by the system operator. And the system operator is a non-government organization, nonprofit, with a very simple mission, which is basically, reliable electricity at least cost. And it is, in electricity, it's a really quite a difficult technical problem that they're solving to find the clearing prices and performing the settlement function. The problem here in the treasuries is trivial in comparison. And I don't mean to, the politics are not trivial, but the technical problem of performing the clearing is trivial. You have to be able to sort numbers and things like that, which we're actually pretty good at. So I would actually use a model from an area where it works, where we know it works. And so look at the best practice in electricity markets and what are good governance structures. And that would be my view. But Darrell, please, you've got the much stronger connection to the financial community.
So there are two main options. One is to have a new government-based utility, and the other is to extend the footprint of the existing central counterparty for the US Treasuries market. I mentioned that already 22% of US Treasuries are centrally cleared, or transactions are centrally cleared. That's at the Fixed Income Clearing Corporation, which is a subsidiary of DTCC, whose other subsidiary, the NSCC, National Securities Clearing Corporation, does all US equities central clearing. So they have the infrastructure in place, and it does work. I think the main impediment, as you indicated, is not the technology, but rather the will to move forward and extend the footprint from 22% of the market to, say, 90% of the market, which is what happened in the US interest rate swap market when Dodd-Frank forced central clearing into that market. That market basically underwent the improvement that I just promoted, and liquidity has improved by a factor of 10 in that market in terms of bid-offer spread.
Yeah, to me, it's quite a compelling story, and I'm not surprised. It would really be very useful for, I think, everyone to try to navigate how we can get from point A to point B through the political process. But from my point of view, and this is consistent with Milton Friedman's famous line that there's this tyranny of the status quo that we have to overcome. But two things help us overcome that. And one is having well laid out plans of what we should be doing. And that's where you come in, Darrell. And then the second is we need a crisis in order to get people to do something, because they see that actually, this has real ramifications for our economy. And that's where COVID and other things come in. So I think we do have the crisis, and we just need the plan. So how do you see that plan developing in the next the year or two?
Okay, so these sorts of things don't happen overnight. In the case of, I mentioned the Dodd-Frank Act, it took about 5 years from beginning to end before it was really going full steam. And so in the US Treasury market, step one, which might take a year or so, would be to do the quantitative study that you and I discussed earlier today, and see where the costs and benefits are, assuming that it goes forward, to see how widely this should be done, who would be mandated, what types of transactions would be included, how would the mandate work, basically. Then the people in the plumbing of the US financial system are going to roll up their sleeves. And if they get the request, they're going to, put out proposals for how the regulation would be implemented, and the software and, the onboarding of investor market participants that are not currently central clearing, the needs for margin requirements and default guarantee funds, liquidity commitments, all of that has to be designed. That would take another year. And then onboarding would take, over time, another couple of years. And then we could be up to full steam in 4 or 5 years if they really went at it right now. But right now we're at the debate stage. So all of that is going to get delayed until the official sector decides that it really wants to take a hold of this problem.
Another question is the too big to fail issue of the fact that the central clearing organization becomes systemically important, and how can we mitigate that risk? So let me just pursue again how we do that in electricity. And the way it's done in electricity is the system operator never takes a position in anything. They're simply performing the clearinghouse, the clearing function, establishing the prices and observing the allocations, and then performing the settlement consistent with the market rules. And I would envision the same thing here. So to the extent that there is non-performance by a market participant, then what would happen is necessarily that non-performance would be, that cost would be socialized among all market participants. That's what we do. And the reality is, in electricity, despite this huge volatility, we actually have collateral arrangements that make in the best practice markets, such as Texas, where the default is almost never happens, and the magnitudes tend to be trivial, like $10,000. I mean, even though that it's many hundreds of millions that are trading all the time. So to me, it seems like this is totally manageable, given that the task that they're doing is fairly simple. They're not taking positions. And so the worst thing, as you point out in that slide, is that you get non-performance by the market participants, and then somehow that has to be made up. Would something like that work in the financial sector?
Yeah, it's already happening in the financial sector, and you're absolutely right. The vast majority of the risk that must be managed by the central counterparty is socialized among the major market participants. So they, in the event that a clearing member fails, those positions are liquidated, and any losses are socialized among the other clearing members. However, and I think this is a good idea, the platform, the clearing operator has to have a small amount of capital in the guarantee fund, basically to provide an incentive to do a good job in setting the margin requirements and the guarantee fund requirements, and also risk managing the settlement process. Because if they have no skin in the game and they leave everything to be socialized by the clearing members, then they wouldn't necessarily have the incentive to design the central counterparty carefully. So they're generally expected to put in a small slice of their own capital.
Well, yeah, so that's a very finance perspective. So what happens in electricity is the system operator is regulated by the Public Utility Commission or FERC at the federal level. And these parties watch over what the organization is doing. The system operator has a board that is also watching over, and all the market participants. There's a very high level of transparency with respect to the market rules and the execution of those rules. And as I said, all the data. And it is incredibly effective in making sure that problems are fixed. Then there's another innovation which would be useful in finance, which is we have a market monitor that has access to all the data and makes recommendations about when identifies problems and makes recommendations to, well, we could improve things this way. For example, the collateral basis needs to be more forward-looking about where prices are apt to go, and rather than historical. And then the market participants have working groups that propose market changes. So it's a fascinating comparison, I think, between what we observe in the market design of financial markets versus the market design of another critical industry in our economy, the electricity sector.
Yeah, no, it's two different models. Historically, the central clearing in the US financial markets has over time devolved into the private sector. Part of that, I think, is the innovation that the private sector technology providers provide with a profit incentive seems to be working. But maybe it's different in the electricity market, or maybe it's just two different approaches. Yeah, go ahead, Peter, sorry.
Yeah, so I'm just to give a little pushback on that. This is an operation that is incredibly simple. It's like crossing supply and demand and finding the intersection. So I'm wondering how much innovation that we actually need in order to solve that technical problem. By contrast, in electricity markets, it's an incredibly complicated economic problem that they're solving. But fundamentally, it's balancing supply and demand. We're just doing it at every location. We're doing it at every instant in time, and have all these transmission constraints and the like. But my point is, you can actually have good performance and innovation in market rules through a governance process rather than pure financial motivation. And so I actually would recommend it be a nonprofit, and it doesn't need to be government. System operators aren't government. They're nonprofits that are regulated by the government.
Yeah. Well, I can see the cost benefit on that. It's definitely worthy of discussion. Maybe at the top of the hour, if you can hang on for a few minutes, I can explain some of the financial complexities involved in a central counterparty because of the different types of assets that are centrally cleared in the same batch, and all of the risk management and pricing issues that come up in that case. But maybe they're similarly complex in different ways.
Yeah, absolutely. And I didn't mean to suggest that finance is easy and electricity is hard. Everything's hard. So the real world is complex, and it's complex in finance. It's complex in electricity. But the particular function that we're looking at, I think, is it should be my view. I'd love to learn more, But my view is that it will be manageable, and I suspect you think that's the case too.
Yeah, I don't think it's a slam dunk either way.
Yeah, good. Let's see, there's just so many questions here. I can't have you address all of them, so I will bring them up. Is there any of the panelists that would like to raise a question directly? If so, you can just unmute yourself and jump in.
So if it's okay, Peter, I would like to ask a question. So, and that kind of reflects a lot of questions in the Q&A. So what are the downsides to your proposal, in addition to the ones that were already raised in terms of the stability of the central counterparty and systemic risks? How would it affect foreigners' access? And are there any competing proposals to fixing the market that, you said it's currently in the discussion stage. So what else is being discussed? Thank you.
Yeah, so yes, there's not all benefit, there are costs. The systemic risk, I actually think, with enough time, I could talk you into the view that systemic risk goes way down when you introduce a central counterparty. But there are other costs. For example, right now, if I'm a large investor, I don't need to tell anybody other than my counterparty to the trade, what I'm trading and when I'm trading. But if I centrally clear, generally speaking, the central counterparty is going to find out about it. That means there's at least two market participants that know, my trade counterparty and then the central counterparty. And that information is all being stored somewhere. So there's, more transparency is good for social purposes and regulatory purposes. But some investors, especially some offshore investors, maybe some official sector offshore investors, might say, you know what, we don't really like this idea. We liked the old way where we could trade more in the dark. So they might say that's not for us. There's also the issue that Peter brought up and that I would support, which is you need commitments of capital and liquidity at the central counterparty. And those commitments are not upfront right now. They're on a discretionary basis in the current market design. So if you want to trade with me right now, I could demand a certain amount of margin and I could provide liquidity to you when I want to. Whereas if you impose it upfront, all of the commitments for capital and liquidity at the central counterparty have to be pre-committed. That's a significant commitment of liquidity and capital. So it's kind of a pay up front and be assured of market liquidity and safety at all times, or don't pay it all the time, and then there's a less on average commitment of capital and liquidity, and then suffer the consequences when markets become dysfunctional. So there's a cost-benefit trade-off there, and I would argue that paying a bit upfront all the time in terms of commitment costs is better than not paying as much all the time and suffering the consequences of dysfunction occasionally. But other people could differ on that. That's two of the examples, that might come up. I see someone, Satish, is asking if this notion of central counterparty is similar to what's used in the exchange traded futures market. Yes, absolutely. The Chicago Mercantile Exchange does exactly this for exchange traded futures.
Yeah, and the other thing this opens up is the possibility of rethinking the structure of the Treasury auctions, and not just the trading of the Treasury securities, but also, should the Treasury auctions be structured in a different way? Perhaps, the products that are auctioned could be improved. Do you see any innovations along those lines that might help with this problem, or is that sort of a totally separate animal?
Yeah, so the primary market for US Treasuries is an auction-based market. And in my view, it would be appropriate to have the issuance of auctions in the primary market centrally cleared in the same central counterparty because of the benefits of netting and also safety in that market. And there are some issues with respect to settlement in that market. I also think that the US government in that auction would get better prices on average if the secondary market had central clearing and all-to-all trade, because it would be more reliable, low-cost trading in the secondary market would back into a higher price for US Treasuries in the primary auction market. I don't think it directly affects the auction design itself, which, as you know, Peter, has changed over the years and is not an easy, it's a multi-unit auction that's not an easy design, and there's no theorem that directly applies that I know about, at least, in that market. Although I know you've written a paper that describes evidence that the uniform price auction performs, if I remember, somewhat better under some circumstances and somewhat worse under other circumstances. Is that right?
Yes, unfortunately, the economist has to say what they usually say, which is, it depends.
Yeah.
No, I'm strongly, here I agree with Milton Friedman again. The uniform price auction is definitely the way to go. And it really is more with respect to the definition of the products and the, just clever ways of improving liquidity in the market or simplifying the market to improve liquidity. But I completely agree with you that this issue of the primary market prices are improved by improvements in the secondary markets, absolutely true. So these two markets are linked through arbitrage. And so, yeah, frictions in one impact the other. And we want to reduce the frictions in both. Absolutely.
I see a question from G. Bush. I'm wondering if that's Georgina Bush, asking about observations on CCPs and other markets so far. And generally the experience is quite good in other markets, whether it's equities markets, derivatives markets, as someone asked, like futures markets, options markets, government bond markets in Israel, I mentioned this morning. Generally speaking, all-to-all markets with central clearing works better, provided the underlying asset is not too customized. It has to be a standardized, somewhat widely traded asset before this all makes sense. And I do think that it's not just the central banks that have to make this decision, it's the entire official sector. In the United States, for example, the Fed could not do this on its own in terms of decision-making. It would be the Treasury Department would be the leading agency, and the SEC, the Securities and Exchange Commission, and the Fed would need to be involved in the regulations. So and that's one of the reasons. Somebody asked, why is it so hard to do with treasuries? That's one of the reasons that it is hard to bring this into the treasuries market. There's no single agency that could do it on its own. And also it may require legislation to mandate central clearing, just as the Dodd-Frank Act was congressional legislation that mandated in the swap market.
So one final question in our last minute, is there any hope of improving transparency in the market in a meaningful way? Why is it the case that I can't see the bids from 100 years ago, that would somehow adversely affect the market participants?
The answer is no good reason. And I'm not sure why transparency is taking so long. It's, first of all, it wasn't an easy data collect to do, but it has been done. The FINRA has the bulk of the transactions data already. And they haven't released it to the public. And as you say, transactions that occurred months ago, there's no reason that those should be private. Anyway, they're anonymized by who made the trades. We should have those data. And I think it's an undue amount of delay in getting those data made public. They could also be improved even for the regulatory sector. And that's another great project for the government.
Excellent. Well, on that happy note, let's conclude today at 10 o'clock. And thank you very much, Darrell. Thank you, everyone, for participating in this event. I certainly learned a lot.
Thank you, Peter.
Thank you so much, Darrell and Peter. And we'll have the video available, and we'll forward all the questions that we weren't able to address. Thank you.
Thank you so much. I'll stay on.
Yeah, I'll stay on too. The landscaper, we're off the air now, right?